Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Business as usual. The Fed keeps rates unchanged, citing inflation risks, but two governors vote against the decision in favor of making a cut, marking the first double dissent in more than 3 decades. More deals. President Trump hit South Korea with 15% tariffs. India, meanwhile, will face a 25% rate, possibly going higher over its Russian energy purchases. And Canada has become the latest G7 nation, planning on recognizing a Palestinian state in September, a move that's been quickly rejected by Israel. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. I almost don't know where to start. There is so much information that has come through in the last 24 hours, the big event being the Fed. But again, the Fed chair is sticking to wait-and-see mode, not committing at all to a September rate cut. And what we saw is markets price out the possibility of that happening in September. Going into the meeting, we had about 45 basis points worth of rate cuts priced in from now to the end of the year. We're sitting at around 30 basis points now. So that tells you the interpretation from the market was that it was a hawkish Fed. You also had very strong earnings come through from Meta, Microsoft, strong after-hours performance there, almost double-digit for both of them. So you can see the Nasdaq up 1.3% futures this morning, S&P up 0.9% as well, getting a bit of a boost from these earnings that are coming through. Two-year yields down 3.92%. So again, we sold off a little bit. Yields moved higher after that Fed announcement this morning. We're down again about 2 basis points. But the point is that the interpretation was that this was a more hawkish than expected Fed meeting. And the USD slipping a bit, down 0.1%, as we also speak to some of the new trade deals that the U.S. have announced overnight with the likes of India and South Korea, and pledges to do more before that August 1st deadline. We are 1 day away. So with that, let's talk about how some of these Asian markets are reacting to the deals overnight. And, of course, the Bank of Japan, too. So much going on in your space, Avril.
Absolutely, Jumana. For the BOJ, we were expecting it to leave things on hold and really watching for what the tweaks to growth inflation outlook was. And for CPI, actually, the tweak was relatively mild. So that's helping dollar-yen to pull further away from the 150 danger zone, as our MLife strategists have characterized that. But aside from that, Asia stocks are lower. You have Hang Seng, really the drag today. We had weak PMI numbers and unexpected worsening on the manufacturing front, so showing you that softness in activity there, and at a time when exports for China not looking that great, and uncertainty still. Are we going to see this US-China trade détente extended in South Korea as well? Even though 15% tariffs is seen as a good outcome, today the drag is coming from Samsung after an earnings miss, and then just very quickly highlighting what we're seeing out of India stocks, that drag you're seeing against the backdrop of these levies, 25% that could be imposed and more to come potentially. And this is among the highest levels we're seeing, if not the highest in Asia, Jumana.
Yep. Thank you so much, Avril. And let's not forget, it's earnings season still, so a bunch of earnings hitting. Just getting results through from Standard Chartered. It is a beat. Second quarter adjusted pre-tax profit, $2.4 billion versus estimates of $1.9 billion. They've also announced a $1.3 billion buyback. They see 25 growth around the bottom of the 5 to 7% range. Operating income to increase 5 to 7% in 23 to 26. The return on tangible equity approaching 13% in 2026. They still talk about heightened uncertainty around trade tariffs, and of course, Standard Chartered, one of the banks that perhaps are a little bit more exposed to tariffs given the global nature of the bank and its exposure to emerging markets. And then other guidance, they are saying they expect saves of around $1.5 billion, cost to achieve of no over $1.5 billion from Fit for Growth, plan to return to at least $8 billion to shareholders between the 3 years of 2024 to 2026. But bottom line is, second quarter adjusted pre-tax profit is a beat, $2.4 billion versus estimates of $1.9 billion. And later on, our colleagues on Daybreak Europe will be speaking to the CEO, Bill Winters. So stay tuned for that interview. Now, President Trump says he's reached a trade deal with South Korea, imposing a 15% tariff on its exports. Seoul has also agreed to invest $350 billion in the U.S. and buy $100 billion in energy products.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
Okay, more deals as we get closer to August the 1st. Let's take a closer look at this one and more with our senior editor, Bill Ferries. Bill, there seems to be a bit of a template that has been set up in the last few days. It's not just about the reduction of the tariff rate, but you're also getting countries committing to invest in the United States and also committing to buy energy products from the U.S. What does this all mean for a country like South Korea, especially given the negative market reaction that we're seeing on the Kospi today?
Yeah, I mean, for South Korea, I think it is. It's definitely better than. It's not the worst case scenario. It's probably better or at about what they expected. It is similar to the deal Japan got: 15%, a $350 billion fund that will invest in the U.S. South Korea did manage to protect a couple key areas, including beef and rice imports from the United States. That was something that was politically very sensitive for the South Korean government and the new President Lee, who just took office in June. So it is, frankly, one of the better deals. We're in a strange new world where 15% tariffs are up from about less than 2% at the start of the Trump administration, but 15% still seems like a relatively good deal compared to what some other countries have gotten, such as India.
Yeah, let's talk about India. And actually, Trump seems to be making a few comments about the deal now, saying we have done very little business with India. India tariffs are too high. And says, I don't care what India does with Russia, of course, referencing the fact that India continues to buy Russian oil. What do we make of the fact that India got a 25% tariff rate and South Korea got 15%?
Yeah, it's an interesting turn of events because we know President Trump and President Modi have had a good personal relationship going back to the first term when each of them hosted the other. President Trump has again hosted President Modi, Prime Minister Modi, back at the White House this year. The two leaders seem to get along, but we have seen increasing frustration from President Trump about India's policies. Among the things he's taken issue with is the fact that India is a member of the BRICS bloc, the fact that you mentioned that India buys a lot of weaponry and oil from Russia. Those have been two issues. And India has had a long-standing policy of tariffs to protect domestic industry. That has come up repeatedly in the talks between the two countries. So I do think we see kind of the range of possibilities here between South Korea coming in at 15%. And India at 25%. If there is a silver lining for India here, it does seem that the initial reaction from both sides is that perhaps some talks will continue. So even though August 1st is the notional deadline here, there does seem to be some signaling that perhaps a better deal will be in line down the road.
Yeah, and perhaps later today as well, with other deals expected to be announced, including potentially one with Thailand, too. So we'll keep a close eye for that. Bloomberg's Bill Ferries, thank you. Now, Fed Chair Jerome Powell has warned that the central bank needs to stay on guard against inflation risks as the FOMC kept rates on hold. The 9-2 vote saw two governors support a rate cut, the first time since 1993. A Fed decision has had two dissenters.
I think you have to think of this as still quite early days. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer. But, you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time.
Joining us now is Dan Farley, Investment Solutions CIO at State Street Investment Management. So the Fed Chair, Jerome Powell, not succumbing to any pressure. Certainly there's a lot of political pressure, wait-and-see mode, and if anything, I would say being very cautious about laying the groundwork or the foundation for a September rate cut. How do you interpret yesterday's press conference?
Well, I thought his comments that you point out here, it was actually quite interesting. I was very keen to see how he was going to start to message September, or whether he was going to start to say enough progress has been made or enough clarity was coming on tariffs, and he didn't go down that path. So I think that the The outcome of the day isn't very much a surprise. There really hasn't been enough data, I think, to have given them the comfort to move forward with a rate cut. So that pretty much in line with everybody was expecting. But it does leave the door open in terms of what might happen in September.
Yeah, I guess I'm surprised to see that the dots are still projecting 2 rate cuts by the end of the year. But yesterday he refers to the labor market still looking solid. You still have inflation slightly above target. So what is the justification to cut rates at this point?
Well, at this moment, there isn't much, and that's why they didn't do it. And I think that's why they continue to go back to this point around the data is so important that they need to start to see that flowing through. And that's why I think the end outcome isn't that much of a surprise. They don't have the air cover to have made that decision. I think people are all looking forward to what could be as the desire to say that he would commit to something. But they've been very clear all the way through that they weren't going to take that kind of.
What's the House view on what the Fed do next?
Yeah. So we think that they're likely to do 50. We think they actually probably should do 75 this year. And we say that because the trend that we've all been seeing has been a slowing economic growth rates. It has been inflation that has been trending down. Admittedly, in the first quarter, we saw a bit of a tick up. The tariffs are adding to all of that. But the trend is going in the wrong direction. And we think that they are falling behind on this point. Now, the reality is, until they get that data to support it, they're really not going to be able to move. You saw it in his comments yesterday. They're still very, very cautious about moving too quickly and having inflation turn the other way.
Yeah. Let me ask you about all of the trade deals that are being announced. And I feel like the price action after those deals are announced is pretty interesting because the country that agrees to the terms of the deal tends to underperform in the days afterwards. So I think there's a perception that these trade deals are actually ultimately benefiting the U.S. and not necessarily benefiting the other countries in the deal. Do you think we've moved to a stage now where investors, at least those focused on the U.S. market, are less concerned about what's in these trade deals? We've moved on from trading all of the tariff headlines?
I don't know if we've quite moved on from it, but I think we're definitely sort of identifying the playbook, as you noted a few minutes ago, that it's a rate that's in around 15 to 20%. It has a little bit of investment. It has an energy buy. It might be a couple of other things. So I think that pattern is definitely showing itself up. I think that the fact that we're coming in at levels that were a bit lower than people were expecting, I mean, clearly off the highs of April, but coming in lower than where people were expecting gives a little bit of comfort. I'd also say, to your point, that the markets do sell off a little bit, but then a few days later, that just sort of washes away. Right?
Yeah.
So I think it's definitely been a situation where, buy the rumor, sell the news kind of moments.
Well, this was always going to be a big week for U.S. markets, and we've got stellar earnings out of Meta and Microsoft overnight. To what extent do you think that's going to be setting the tone for where U.S. markets go from here?
I think that's one of the most critical things that we can look at here, particularly in U.S. markets. And while we're slightly positive on equities in general, we are much more positive on U.S. stock markets. The economic backdrop there is stronger than other parts of the world. The earnings piece of it, most importantly, is strong. I can't say that U.S. stocks are cheap, but we need the E in the PE ratios to come through in order to justify those valuations. And thus far we've been seeing that.
Yeah. Do you think U.S. exceptionalism is back then? Remember that whole theme got tested a couple of months ago?
Well, look, I think that the concept is waning. All right. I think that the fact that the U.S. has been able to continue to deliver growth, in our mind, will have legs to that and will be a tailwind for U.S. stocks. But it does seem that the world is leveling out, and I think you're starting to see improvements in Europe from a fiscal spending and from a growth rate perspective. You're starting to see some improvements in pockets of Asia. So I do think that the investment story widens out a little bit, that it isn't just about U.S. stocks, but in the near term, that's probably still going to be the case.
Okay, so in this environment altogether, what would you rather own, fixed income or equities?
I'd rather own equities.
Still?
I
because of that AI story?
Well, I think AI is part of it. In fact, that's probably the piece that could potentially be that catalyst for productivity, much like we saw in the 90s that the internet was. Right? We'll see how that ultimately plays out. It will take a little bit of time, but I think earnings will still grow. Economies are growing fast enough that it'll move stocks better than bonds.
Yeah. Great to chat to you, Dan. Thanks so much for coming on our
Good
show.
to see you.
Dan Farley, CIO of Investment Solutions at State Street Investment Management. Oh, coming up, as we just spoke about, Meta and Microsoft shares rise in late trading, with both companies focusing on AI investments. Details next. This is Bloomberg.